Hey, what's going on, everyone? Lewis with Macro Thinker here. Inflation is the hidden tax that is gradually stealing our wealth and eroding our purchasing power. So in today's video, we're going to talk about what inflation is, what causes it, the different types, and more importantly, how we can get on the right side of inflation and use it to our advantage. All right, so we have a lot to cover today, so let's jump right into it. I'm going to use Investopedia to help me explain the concept of inflation. So very simply put, inflation is the decline of purchasing power of a given currency over time. So to keep things super simple and illustrate how inflation works and how it erodes your purchasing power, we are going to look at a chart that Investopedia provided showing how inflation has changed the price of a cup of coffee over time. So the currency in question here is the dollar. The timeline is roughly 50 years, and the good that we are trying to purchase is a cup of coffee. According to this illustration, in 1970, 1 cup of coffee was 25 cents. In 2019, 1 cup of coffee was $1.59. Now, nominally speaking, the currency unit has not changed at all. 25 cents in 2019 is the same 25 cents in 1970. And additionally, the $1.59 in 2019 is the same $1.59 in 1970. The difference is that inflation eroded your purchasing power. And how do we demonstrate that? Well, if we take the $1.59 and we bring that back to 1970, how many cups of coffee would that purchase you? So if we pull up a calculator and we plug in $1.59 and we divide that by the average cup of coffee in 1970 at 25 cents, we find out that that $1.59 would actually buy you roughly 6 cups of coffee in 1970, whereas it will only buy you 1 cup of coffee in 2019. So then the question becomes is how much purchasing power did we actually lose in that 50-year time span? Now, to calculate the loss of purchasing power, we would take the cost of the cup of coffee in 2019, which is $1.59. We would subtract the original cost in 1970 of 25 cents. That provides us with a $1.34 in price difference. And then we would divide that by the 2019 price of a cup of coffee. Now, this is indicating that the dollar has lost roughly 84% of its purchasing power in that 50-year time span. So you see, even though the dollar value or the nominal price of your currency has not changed, the cost of goods and services have gone up to the point where your currency purchases less of those items, and that is caused by inflation. So what causes inflation? In general, an increase in the supply of money is the root of inflation, so expansion of the money supply. Though this can play out through different mechanisms in the economy, money supply can be increased by monetary authorities, either by printing and giving away more money to the individuals, stimulus, by legally devaluing, reducing the value of the legal tender currency, most commonly by loaning new money into existence as reserve account credits through the banking system by purchasing government bonds from banks on the secondary market. And speaking of purchasing government bonds from banks on the secondary market, let's take a quick look at the Federal Reserve's balance sheet. So up on the screen, I have a chart that shows the total assets of the Federal Reserve. And I located this on federalreserve.gov, and it demonstrates the trends in their balance sheet. Now, this chart dates back to 2008, and you can see the trend on how much bonds they have actually been purchasing. So after the great financial crisis, in an effort to stabilize the economy, the Fed started purchasing mortgage-backed securities and expanding their balance sheet. You could see a huge tick up here, which was at the time a very monumental move. Now, clearly that has not stopped at all. We saw increases all the way into 2018, at which point the central bankers and policymakers started to taper slightly. Well, you can see coming into 2019, the trend starts going down and their balance sheet starts to decrease. Now, I have a vague recollection of this. However, I do remember when the Federal Reserve started to announce that they are going to be tapering their purchasing of the mortgage-backed securities, that not only did the 10-year Treasury yield spike up, we saw mortgage rates rise, and we started to see the price of assets come down. And then, of course, once the pandemic hit in March of 2020, their balance sheet absolutely exploded. It nearly doubled in a 1-year period of time. The article goes on to say that in all such cases of money supply increase, the money loses its purchasing power. Then the setup that we are seeing moving into the future is more and more inflation. Now, the mechanisms on how this drives inflation can be classified into 3 different types: demand pull inflation, cost push inflation, and built-in inflation. So let's take a look at all 3 of those, starting with demand pull. So demand pull inflation occurs when an increase in the supply of money and credit stimulates overall demand for goods and services in an economy to increase more rapidly than the economy's production capacity. This increases demand and leads to rising prices. Now, to demonstrate how demand pull inflation works, I'd like to relate it back to something that everyone can relate to, which is housing or purchasing your first home. There are many people out there that are trying to buy a home, and it is becoming increasingly more difficult due to a shortage of inventory. Well, the Biden administration recently proposed, this is not something that is put into place yet, but they proposed a first-time homebuyer tax credit of anywhere from $15,000 to $25,000, and those funds could be immediately applied towards your down payment. So there are 2 things at play here. One, they would be increasing the money supply by giving this money directly to the consumer if they choose to purchase this particular good and service. In this case, it would be housing. The second thing they are doing is incentivizing people to act today rather than waiting a period of time that it takes to potentially save up for a down payment, put yourself in the right financial position, and get all of your ducks in a row to be able to purchase down the road. Now, there's nothing wrong with this, but the reason why I'm looking at this and wanting to relate it back to demand pull inflation is because there is already a very limited supply of housing inventory. So by pumping this stimulus into the economy and allowing first-time buyers to take advantage of this credit, it effectively will make the market more competitive. So somebody who may have purchased in the next 2, 3, 5 years down the road after they have saved for their down payment and closing costs, made sure that their income was secure, they're going to be more likely to act today. You're essentially pulling that demand from the future and bringing it to the present day. All right, so now let's take a look at cost push inflation. So cost push inflation is the result of increased prices working through the production process inputs. When additions to the supply of money and credit are channeled into commodity or other asset markets, and especially when this is accompanied by a negative economic shock to the supply of key commodity, costs for all kind of intermediate goods rise. These developments lead to higher cost for the finished product or service and work their way through rising consumer prices. So cost push inflation is essentially referring to the materials that it takes to put together certain goods and services. If those material prices rise, the cost ultimately gets pushed onto the consumer in the form of rising prices so that companies can maintain their profit margins. Built-in inflation essentially goes along with this cost push. It's related to adaptive expectations, the idea that people expect current inflation rates to continue in the future. So as the price of goods and services rise, workers and others come to expect that they will continue to rise in the future at a similar rate and demand more costs, wages, to maintain their standard of living. So in other words, as the prices of goods and services rise, wages ultimately need to rise alongside of it in order to maintain a certain standard of living. Now, what happens in real life most of the time is the cost of goods and services go up and wages tend to lag. All right, so now that we understand what inflation is, what causes it, and the different types, let's look at some pros and cons of inflation so that we know how to better position ourselves moving into the future. So inflation can be construed as either a good or bad thing depending on which side one takes, and of course how rapidly the change occurs. For example, individuals with tangible assets that are priced in currency like property, stocks, commodities, they may like to see some inflation as that raises the price of their assets, which they can sell at a higher rate down the road. On the other hand, people holding assets denominated in currency, such as cash or bonds, may not like inflation as it erodes the value of their holdings over time. Now, because inflation erodes your purchasing power, it can actually promote speculation, both by businesses in risky projects, by individuals in stocks of companies, as they expect better returns than inflation. An optimum level of inflation is often promoted to encourage spending to a certain extent instead of saving. If the purchasing power of money falls over time, then there may be greater incentive to spend now instead of saving and spending later. It may increase spending, which may boost economic activities in the country. All right, so stepping away from the article, let's talk about how we can allocate capital to put inflation on our side and hopefully not only maintain our purchasing power, but actually grow our purchasing power. So the first item that I want to talk about is income producing real estate. Now, I know what you may be thinking. Real estate prices are at all-time record highs. And yes, that is absolutely true. But over the long haul, prices of homes tend to track inflation, which means that they appreciate in value over extended periods of time. So if you're purchasing a home today, whether it's an income-producing rental property or a home that you intend to live in, you should be looking at least a 10-year time horizon so that you can weather any fluctuations in the market. The benefit of real estate is that you can make money in several different ways, and inflation works in your favor. If inflation runs hot, prices tend to rise with it, which means that you'll get to see appreciation. The other thing is that the real estate debt is extremely cheap right now. Most 30-year fixed rate debt is hovering at around 3%. So you are not only locking in something that is fixed, but you are also able to pay your debt down at a faster rate because you're paying less interest than you would if the interest rate was, let's say, at 6 or 7%, which is more of a historical average. In addition to the interest rates being low, I'd like to point out that if inflation is running at, let's say, 3 to 5%, but the interest rate on your 30-year fixed rate mortgage is 3%, then that delta, the difference between inflation and the rate at which you're paying for your mortgage, is actually a transfer of wealth from the bank to you. And over time, if your wages rise, you're going to be paying off that 30-year fixed rate debt with cheaper and cheaper dollars. And as an example, let's say your mortgage payment is between $1,500 and $2,000 per month today. Fast forward 10 years into the future, your wages have risen, let's say 30 to 50%, but your payment is still fixed. Your monthly payment will feel substantially lower. Now, in addition to that, if you have a rental property, the rate at which you can rent that home for today is likely to increase as inflation increases. So if a property is generating, let's say, $1,500 of rental income today and increases on average 3 to 5% per year, well, in 10 years, the rental rate is going to be dramatically higher. So the next thing that we can consider are precious metals, so physical gold and physical silver. Historically speaking, the price of gold has kept up with inflation and actually maintained purchasing power. Now, at times, it increases purchasing power or decreases purchasing power, but over the long haul, it tends to maintain it, and it is widely recognized as a store of wealth. Now, physical silver, on the other hand, is more volatile. It has larger price fluctuations. However, it does have a greater utility value in that it is used in lots of consumer electronics, solar panels. In other words, there are various use cases for silver, which might make it a good speculation play and something that you may want to allocate a small portion of your portfolio towards. All right, so that's going to do it for today's video. I hope you found the information useful. Leave your comments below. And if you haven't done so already, please smash that like button. When you smash the like button, it tells YouTube to share the content with more people. And please consider tapping that subscribe button to see more weekly videos on finance, real estate, and investing. Thanks again. Take care.